come Monday, you are going to be launching those 3 soya contracts here. Can you take us through who you think the participants in this market are going to be?
Yeah, good morning, Sarah. I think we expect hedgers to be participating, and maybe just explain the 3 soya products is a soya bean, soya meal, and soya oil. If you crush the beans, you will get 2 byproducts, being a meal and an oil component. And really the participants using futures and options on those would be your underlying hedgers. Now, a hedger for a soybean could be a farmer who, the exchange currently trades a 25-ton physically settled soybean contract. These are cash settled off US markets. So very similar in line with our Chicago corn contract, our gold, our platinum, our crude oil contracts that we've recently introduced. So yeah, now a farmer has a choice. Do we want to use our local 25 contract, which will reflect fundamentals in South Africa, or do you want to use the international benchmark for price risk management? So you've got a farmer component. On the buy side, definitely, we'd also expect to see hedges. They again have an alternative. On the meal side, South Africa imports about 1 million tons of meal. Meal is a high source of protein, so a lot of the animal feed industry is seeking and importing that meal to use that in that sector. And therefore, an importer now can fill up a ship of meal and not run the risk of any price differentiation. They can hedge that component in South Africa in rands. So you've locked out a lot of the other variables in the scenario. And then oil goes into the food processing sector. Again, another opportunity for the market to hedge. So you can get the general drive. I'm talking about hedging, hedging, hedging. Core, I think that's where we see the big demand to start with. And without speculators, a contract is always not that successful, but I think what we will see is some attraction on the soya bean side in the US markets. Certainly a lot of speculators using that. So again, it's a very niche and specific market. I think the South African investor needs to do some homework on soybean production internationally to get a feel of, is there going to be a shortage? Is China going to be buying a lot of soybeans? Just to get a feel of the dynamics of the market. And yeah, I wouldn't say we'd see too much speculation on the meal and oil. It would really be around beans if there's going to be.
Okay. And in terms of other products that the JSE is rolling out or planning to roll out in the near future, as far as commodity derivatives are concerned, what do you have in the pipeline there?
Yeah, as far as the exchange or commodity division has 2 really product sets, physically settled and cash settled. And the soybean products, the 3 would be cash settled. In the line, I don't think we see any new products in the near term. Who knows? We can always, if there's demand out there from the market, we just need an international benchmark to cash settle against. On the physically settled side, I think sorghum certainly has some potential. We've seen interest there from the banks who want to use derivatives to manage price risk. And so, yeah, certainly we could expect perhaps sorghum in the very near future.
Right. And looking at the broader commodities derivatives market, for the year to March, we saw the number of contracts traded in the futures contracts market up 6.4% and the number of options contracts up some 25%. So we are seeing increased volumes coming through there. Since March, how have you seen volumes?
Look, 2009 was a tough year for us. Commodity markets internationally, they were a lot quieter. If you look at the start, yes, although we don't have the volumes of 2008, I think a lot of traders are frustrated because we haven't seen that activity. It is up. What certainly the core products on the grains desk is certainly our wheat and our white maize contracts. And white maize, huge surpluses out there in the market, so less volatility. I think if you're looking at a derivative market and purely what drives volume, you need volatility. So where there's less volatility, less uncertainty, there's less desire to manage price risk, and that does impact our volumes. But as you say, we've seen a slight uptrend, and I think it's also diversification, having this cash settled product set plus the grains physically settled contracts.
And you've mentioned volatility. Of course, in the last couple of months in the broader equity market, we've seen volatility picking up hugely. How are you seeing volatility within the commodity derivatives market move in the last couple of weeks?
Yeah, if you look at the derivative divisions at the JSE, we have the Savvy Top 40, we have the Savvy US dollar, we have Savvy white maize, Savvy being the South African Volatility Index. So we're plotting what the expected 3-month volatility is going to be. We've seen a sharp increase in the top 40, clearly reflecting the volatility in the financial markets. On the grain side, we're tracking white maize volatility, and because we've got this big surplus, we've actually seen that drop to just below 25%, which is really low. That generally trades around 35% volatility. So less volatility definitely in the white maize market.